Hello everyone, welcome to today's very special webinar event in which we are discussing depreciation and appreciation, the happy reality that you can find both high rental yields and high capital growth in the same location, helped by depreciation. I'm Terry Ryder, founder of Hotspotting. My special guest is the man who knows more about depreciation than anyone else in Australia, Tyron Hyde, who's the managing director of Washington Brown. Now, Washington Brown, in conjunction with Hotspotting, is the publisher of a report we call The Pulse, which every quarter highlights 50 markets nationwide where investors can access above average rental yields, helped by the intelligent use of depreciation benefits. The Pulse report has another key criteria. The 50 locations must also have credentials for capital appreciation. We're going to show you the results of a Pulse report we did from about 12 months ago to demonstrate how effective that report is in identifying locations with great results for investors. So to tell us more about all this, I'm joined by Tyron Hyde of Washington Brown. Tyron, welcome.
Thank you, Terry. And let me just say off the bat, congratulations. What an amazing result this report has achieved, way above my expectations. Like we're talking, and thank you everyone for coming, we're talking 80% growth, right, versus 3%. Is that right, Terry? And that excludes yield.
That's right. We went back to the report we produced, because we produce this report quarterly, and we've been doing it now for a couple of years with you. And we went back and looked at the edition that we published just on 12 months ago and looked at what's the capital growth result, because we select these 50 locations for their higher rental yields, but we also have that additional criteria. We're not picking small country towns or mining towns. We want places that are going to show sustainable capital growth. So we went back and had a look at the results. How much of these 50 locations we chose 12 months ago, how much have they grown in terms of their median prices? And the average across those 50 locations was 18%. And that equated to, I think it was 95,000 as the average capital gain based on the median prices. There was only one of the 50 locations that didn't grow in value.
Wow.
So 49 to 50 did, and the average growth was 18%. That at a time when nationally, median price growth in the last 12 months has been something like 3 or 4% as an average across the nation.
And just put that in perspective, that excluded the yield. So you're talking 80% growth, excluding the 6% rent that on average people would get from those suburbs or those regions.
That's right. It's just purely the increase in the median house price or the median unit price for those markets that where we were focusing on the unit market. The yields, in addition to that, and 6% is the minimum criteria to make it to this report. Some of the locations we included 12 months ago, 7 to 8%, although between 6 and 6.5 is more common.
If you're in the stock market, Terry, you had a fund and you had an 80% versus a 3% market, like if you're if you have a fund manager and you go, okay, I've got to beat the market average. If you beat it by 15%, you're front page of the AFR, I can tell you, every day of the week.
Yeah. Well, I mean, it's a great result, and but it's great news for property investors, because one of the things about these 50 locations is that they're at the affordable end of the market. The cheaper areas have the better rental yields. But we don't want them to be just cheap areas. We want them to be places they're going to have, they've got the credentials for capital growth. So it's kind of like it's the trifecta for investors. It's the win-win-win situation that investors are looking for: affordable prices, great rental yields above average. So you've got some chance of maybe being positive cash flow or cash flow neutral. And the third win, of course, is you're getting great capital growth, because we're choosing areas that have got that meet our formula for capital growth performance as well.
Just to clarify that, we're not talking towns with 200 houses in it, are we? There's a minimum criteria to make the list, correct?
Yeah, that's right. We have what we call it, excuse me, like half of Australia. I'm trying to get over a head cold. Look, we have a formula we call the empirical formula. Empirical is a word that means the empirical evidence is the evidence that's based on actual results, not theory. But empirical is also every letter of empirical stands for something. The E is for economy. We want it to be a strong, diverse economy. we have a minimum population. At least we prefer locations that have like 50,000 population, because once you get to that size, you've got some chance of having some sort of critical mass. But we will accept places as low as 15,000 if they have special things happening. One of the I's in empirical stands for infrastructure spend. That's one of the factors we always look for in a location. We're happy to recommend places that have got investment in infrastructure, and new road and rail links, hospitals, universities, schools, airports for the bigger cities, but sometimes some of the regional areas as well. So that's a big generator of real estate growth. So we're looking for locations that tick a lot of boxes. It's not just about having high rental yields. So we're not going to have any country towns with population of 200 or 1,000. Sometimes those places have very high rental yields because prices are so cheap, but the prices are cheap for a reason. It's because there's no growth factors.
What are some of the other things you look for?
Well, we look for strong rental markets. That's a great forward indicator for people who are looking for, because media gives us backward looking in. It tells us what recently has happened with prices and what's happened with rents. We're looking for forward indicators, things that give an indication what will happen with prices in the future. So we look at sales activity figures, for example. That's a great forward indicator. Sales activity, which means buyers' demand, is rising strongly. Prices will follow that trend in most cases. But low vacancies and rising rents are also a great forward indicator for prices. It's very rare for a location that has, say, 0.8% vacancies and rents rising at 10%. It's very rare that prices won't also be rising in those sorts of locations. So we look for that. So strong, diverse economy, population of a certain size, minimum number of sales in a year.
Was that 50, wasn't it? I think 50 minimum sales a year.
Yeah, generally we require a location to have at least 50 residential sales in the year. And there's plenty of places around Australia that has less, so we exclude them from when we start searching through our spreadsheets, because we start out with every location in Australia, like over 10,000 potential locations to include in this report, and we whittle it down by filtering out places with low population, low number of sales in a year, various other factors. The infrastructure spend is an important factor that we look for. Lifestyle is also a factor. We find that some of the best performers on capital growth, if you go back 5 years since COVID, for example, there's some figures that show here's the top 10 in Australia for capital growth in the past 10 years. They're all small regional centres. None of them, no capital cities make the top 10 list. But the things they have in common: regional, strong, diverse economies, some sort of lifestyle factor in place. They might be a hill change town, they might be a coastal town with beaches, and good rental yields. And these are
It's funny you say that. It's funny you say that. I remember you were writing an article just during COVID, and you asked me where as an investor, where would I buy? And I got locked out of COVID, so I came back from Bali, where I was living, and we got stuck in a place called Cabarita. And I went, this place is good. This is where I'd buy, right? And, no. Anyway, it ended up being a pretty good investment if you would have bought a Cabarita just during COVID, I would have thought.
We're talking a little bit just south of Tweed Heads.
Yeah.
Well, yeah, it's an interesting one, because I've just been looking at that area, because one of the things that we know to be true is that where there's major infrastructure investment happening, we're going to see property markets responding to that, because a big infrastructure project creates lots of jobs in construction, and some types of infrastructure create even more jobs in operation once they're completed. That area, Cabarita's just had a massive new hospital we built, and that's one of the biggest generators of growth. As a simple formula for an investor looking, where can I buy that's going to have above average growth? Well, have a look around Australia where they're building these big hospital projects. Thousands of jobs in building them, but there's like 5,000 or 6,000 jobs in running them when they're finished. So all these new people come to the area to live, to work in that hospital. Many of them are medical specialists earning lots, big salaries. And they really pump up the property market. So,
well, that's fun, not funny, but a good segue, because I see these ads at the moment that Queensland's doing, saying we're building all these new hospitals, right? I'm sure you've seen them. Maybe it's in the files saying what Queensland's doing, but maybe that's leaning towards why in the next report there's 20 out of 50 are in Queensland. Is there some correlation there, do you think?
Yeah, well, certainly there's a big infrastructure spend happening in Queensland, but no, there's a number of factors. The economy is strong. We've got this internal migration, which is a big factor. One of the reasons why regional markets are doing so well with capital growth is that we've got this huge trend we call the exodus to affordable lifestyle, which means people are leaving the bigger cities and moving to regional areas, enabled by technology. More and more people can work remotely, and that means that, well, we don't actually need to be in Sydney. A lot of people are in Sydney because they feel they need to be there for their careers, their jobs. And some people have the realization, well, actually, we can be living somewhere else. We can sell in Sydney, buy something of a comparable standard in a regional area and have lots of money left over. And it just revolutionizes their lifestyle. Money in the bank as well as a nice home, and able to work remotely in many cases. So that trend is one of the reasons why regional areas are doing so well. But one of the things that can also attract people to move to say a Toowoomba in Queensland, or that Cabarita area in the northern part of New South Wales, or Bendigo in Victoria, there's a really big infrastructure project. They might move there to work on the construction, like it and stay. A lot of people do, or they might be attracted to work in the end project, whether it be a hospital or a university campus or whatever. So that factor is really influential.
Also noticed Darwin was a bit of in the next Pulse report. So just to recap, so does every report have new suburbs, or is there some that overlap from each quarterly report?
Yeah, so some stay, but we're always looking for new ones. So it's not each quarterly edition isn't just a repeat of those past 50. Maybe 20 or 25 stay because they're still good places to buy. They've still got high rental yields, but we'll be introducing new ones. And the reality is it's become harder to find those good locations.
Well, that's right.
Above average rental yields, because prices have risen so much in so many parts of Australia, including these sorts of places that we're nominating for this Pulse report, that prices have risen more than rent, so the yields have started to come down in those locations. So it's becoming a little bit harder to find the places that meet the criteria. Now you mentioned Darwin, and that's one place that does. It's very quickly become the hottest market in Australia. Suddenly everybody, it's a little bit like how Perth was recently. For a couple of years, everybody wanted a piece of Perth because they read there was a boom on. Well, our research identified Darwin as a coming market about 6 months ago, and it's very quickly become, at the latest price data, it's leading the nation on price data, but it's got by far the cheapest real estate in capital city Australia, because technically it is a capital city, a small one, but nevertheless it's the capital of the Northern Territory. But not only the cheapest houses and units, but by far the highest rental yields in capital city Australia. So you can buy the typical house in Darwin or Palmerston, which is the satellite city alongside Darwin, and be buying in the 400,000 and 500,000 for houses, and be getting 6-7% rental yields. And then if you go to units, which is also a major new trend across Australian real estate, where units are really performing well on capital growth. And then you're getting well above 7% rental yields in Darwin. So yeah, it's become a very popular market in the last 6 months for investors wanting to buy there for all those reasons. But we wouldn't recommend it if we didn't think and thought it had the credentials for capital growth, and its economy has improved. There's, relative to its population, its infrastructure spend is very big, and so it's got it ticks a lot of boxes for us. So we are going to expect to see that when we do an analysis of the report we've just published this month, in 12 months' time, we expect to see really strong capital growth results for those Darwin locations that are included this time.
I feel like, because I'm going to show everyone later, I went and did a bit of a deep dive in certain areas, and I looked at the areas recommended, and some areas where it was hard to find properties that matched the criteria, but there was other areas where there was, right? But I feel like that when you release this report, a lot of buyers agency jump on these and go on you and see what you do and claim it as their own. Do you reckon that happens?
Look, it certainly does to a certain extent, and sometimes we ask ourselves, to what extent are we creating hotspots?
Yeah.
And sometimes people kind of almost accuse us of that, like you nominate an area and everyone wants to go and buy there. Look, I don't think we have that much influence. It's lovely to think that people think we do. We may have some influence. There's no doubt, for example, that part of the reason why Darwin is pumping and prices starting to rise is that there are certain buyers agencies that are really targeted Darwin for its cheap prices and its high rental yields. So that can be a factor. But there are other factors in play. I mean, Darwin's rising for really good, solid reasons. It's one of those places that's its economy is a little bit volatile. There's a certain reliance on the resources sector, which is a little bit of a worry, but there are other things happening there. It's got a big defence economy, for example. It ticks a lot of lifestyle boxes. A lot of people like to be in Darwin in winter because, as opposed to Melbourne, for example, a very different climate. Tourism is big, so there's got a number of different economic sectors are driving things in Darwin. So we think that for the next couple of years, 2 or 3 years, it's going to be a real growth market.
Very good. I've been looking at it myself, to be honest. Units versus houses. I know you've been saying units are going to making a comeback in some ways. Obviously, that's obviously a affordability issue, I guess.
It's not just affordability, but firstly, yes, I would say for the last 2 years we've been charting this change to the dominant paradigm in real estate because everyone will tell you that historically, at least, houses on land have shown better capital growth than apartments have, and that old saying that's kind of relevant to what you do for a living: land appreciates and buildings depreciate.
Which is a good thing, everyone. Which is a good thing.
Yes, of course. You can use that to your advantage, and Tyron's going to show us.
I'm going to.
How that works. Tell us a bit more about it because it can really change your bottom line, and that's one of the things we want to get to today. But no, what we call the rise of apartments is definitely a big change in property markets. It's always been the case that apartments are cheaper, and it's always been the case that apartments tend to have better rental yields than houses, but it hasn't had the capital growth factor, and so a lot of investors have much preferred to invest in houses on land. But we've seen a big change in that, what we call the rise of apartments. More and more people opting to buy apartments, and that's driving capital growth performance that's not only competing with houses, but outperforming houses now in many locations across Australia. Not just affordability, Tyron. There are lots of cohorts who are buying for other reasons. You can get a really good location more readily, close to what you want to be close to, with an apartment building than often you can with a house in the suburbs. There's the low maintenance lock up and leave factor that people like. Young people perhaps don't want to spend their leisure time weeding gardens and mowing lawns. Apartments sort of like almost a no maintenance lifestyle. There's also the safety factor. There's a lot of media about crime, particularly in our biggest cities. Melbourne's had a bit of a wave: home invasions, burglaries, car theft, and people more and more are saying, when people say that they like the safety and security aspects of being in an apartment building.
I get that.
Yeah,
I get that. Definitely get that.
So lots of cohorts opting for that. You've also got migrants coming from a lot of migrants. This is why our population growth is so big in Australia. Lots of migrants coming in, and a lot of them are coming from cultures where attached dwellings is what they're used to, rather than houses on a quarter acre block. All these cohorts are feeding into this demand, and therefore better capital growth performance by units.
All right, now Terry, before we get to the really sexy stuff, which is why everyone is here, is about depreciation. I know that's why everyone's here.
Of course.
One final question. If you had $500,000 to invest in property today, what 3 areas roughly would you invest that in?
individual
Off the
areas.
cuff, so just so you know, I've just thrown this at him, so you haven't had a lot of time to think about.
Yeah.
Yeah.
Yeah, well, I definitely Darwin would be on my list of considerations for all the factors we've just discussed. Um, I would be seriously considering some of the regional cities of Victoria, being a bit on the nose for investors because the taxes are high there and the state government's not particularly friendly to investors. But there's opportunities to buy really well, and those markets are starting to rise. There's no doubt the Ballarats, the Bendigos, the Geelongs are really starting to make a comeback. And partly it's that population drift from Melbourne into those areas. So say Ballarat, where prices have dropped the last 2 years, really good buying opportunities to get in there before it becomes a frenzied market. So that would be on my list of considerations. A lot of the Queensland markets have kind of become frenzied. 12 months ago, I would have said, yeah, Rockhampton, Mackay, Gladstone, but they've become so busy, so competitive,
Yeah.
and more expensive, that maybe I'd be looking somewhere like, I noticed there's a big uplift in, say, Wagga Wagga in New South Wales. And I like regional centres like Wagga where it ticks all those boxes in the empirical formula. Big regional centre. It's on the Inland Rail Link, which is Australia's biggest infrastructure project. It's got major hospitals, it's got university campuses, it's got a big military economy because it's got a RAF base and an army base there. And there's a big uplift in buyer activity there just recently. And it's got good affordability. You can buy in the sort of 400,000 and 500,000s there in some of the cheaper areas. So that would be also on my list of considerations.
Interesting you say about the Rockhamptons of the world, where I don't remember about a year and a year ago, we did a talk together. We both thought that Perth was cooked, right? And that went a little bit viral on some of the platform forums out there, and they said us old two farts have no idea what we're talking about. 3 months later, the same people that said that were wrong goes, "Oh no, we don't want to buy there anymore." It's like, so apparently we weren't silly, Terry.
Look, yeah, every market has its day, and eventually it does come to an end. We could see the evidence that the Perth market had peaked, and with each passing month, the price data shows that yes, that peak has been passed because the annual growth figure keeps dropping month by month. It's had a great run. We don't expect there to be price decline, and if people are still very keen to get into the Perth market, we do suggest that they consider units in those inner city areas because they feature very strongly in this new edition of the Pulse report. That's one place where you can buy affordably, say you get a property in the 400,000 and 500,000s, and get those rental yields above 6% in good locations, because we're talking about area like the LGA of Belmont, for example, which is halfway between the airport and the CBD. Sort of frontage to the Swan River. There's all sorts of good reasons why you'd want to buy in the suburbs of that LGA, close to the centre of Perth, affordably and get good rental yield. So, but yeah, be aware that the big growth period for Perth has passed.
The problem is though, when you have this big growth, it feeds on marketers. They are very more likely to sell a house on land package based upon past performance and say, look at what we've done, look at Perth, and just think that everyone's going to blindly make another 12% the next year. Existing apartments, yes, okay, but the big marketers out there can sell the past based and think you're going to get that in the future, which just doesn't often happen.
Yeah. Like we tend to say to people that if you accept that apartments are performing better on capital growth, outperforming in many cases, don't be buying in those sort of 30-story high rise where there's like 300 or 400 apartments all the same. You're going to be paying big body corporate fees because you've got lifts to maintain, and there's probably a swimming pool and a gym. Look, go down the boutique route more, smaller buildings, something with a little bit of individual character, where you're not having to pay those high body corporate fees, and there's not a couple of hundred apartments in the building exactly the same as yours.
But you also get more land value with a small boutique as a ratio, and we all know land appreciates, buildings appreciate, which is a great segue to me sharing my screen and talking about what you're all here for, depreciation. How's that sound, Terry?
Yeah, look, it's really important to have this component of this talk. We're talking about the Pulse report, where it's mainly about above average rental yields, and the spreadsheet that's included in that report includes the depreciation factor. We have the raw rental yield, but then we have the post depreciation rental yield for each location, each of the 50 locations. There's quite a significant difference. And what you're going to show us is how you can use depreciation to get even a better rental yield out of a property that is hopefully performing on capital growth as well.
And I've actually gone into, so I'm going to give an overview of the basics of depreciation, but then I've actually gone into some of the areas that have been predicted in the Pulse, found properties right now that are for sale, right now what they rent for, factored into the depreciation. So let's do it.
Okay.
And see. Okay, so let me know if you guys can see the screen. Is that working?
Yes.
Okay,
so
great.
far, so good.
All right. So I'm not. I normally give a big spiel about myself, but I'm thinking if you're on this webinar, you've either got an email from me or Terry. I'm CEO of Washington Brown. I've kind of started this industry many moons ago, which makes me feel really old. We've helped 320,000 property investors pay less tax with depreciation. I'm the only published author on this topic, which is pretty cool. So we do this nationwide. We have to do it all around the world. So yeah. So what is depreciation? Well, just like you can claim the wear and tear of a car, a ute, if you're a tradie, you can claim the wear and tear of an investment property against your taxable income. The difference is with the car, it's based upon the purchase price. Whereas the investment property, we have to separate the purchase price from the building cost and the land, because you can't claim the land as a depreciated item. It has to be income producing for you to do that. For you to do this, you can't claim depreciation on your house. But in summary, we help property investors pay less tax. Now, there's two components of a depreciation report that we prepare. First is the plant equipment. That's the ovens, dishwashers, blinds, carpet, all the stuff that wears and tears quicker, right? The second part is what's called the Division 43, the building allowance, the structure of the building. Now, in order to claim the structure, it has to be built after 1987. Okay, so if you buy a property that's built in 1985, you can't claim the structure. Now, this represents about 80% of the construction cost of a property. And you can claim that over a 40-year period. From when it's brand new, you can claim the building allowance, the structure of the building, over 40 years at 2.5% flat rate. Put that in perspective, if I was to buy a property that's 20 years old, I've got 20 years left. Okay, it's 2.5% per annum. Now, there was some recent change, well, not that recent anymore. In 2017, there was massive changes in my industry. The government said, in the good old days, we used to go out and we used to revalue all the plant equipment. So we'd go out to a 50-year-old property and we would revalue the carpet and you would start claiming it again. The government didn't like that. They said you're constantly revaluing plant equipment that was already too old. And they kind of made sense. They said that they're going to deny income tax deductions for the decline in the value of previously used depreciating assets. And why they do that? They said this is an integrity measure to address concerns that some plant equipment items are being depreciated by successive investors in excess of their actual value. And they had a point. So what they're saying is now that if you buy a brand new apartment or house, you can claim all the ovens, carpets, dishwashers, etc. But if I sell it to you tomorrow, Terry, after one day, you can no longer claim any of those items. You can claim the structure still, but you can't claim all the carpet, etc. So it's a big difference. This happens nowhere else in the tax law, right? When I buy if I've got running my business and I buy a 5-year-old desk, it's based upon what I pay for that desk, but not in residential property anymore. In commercial, nothing changed. So we're still revaluing plant equipment in a 50-year-old commercial property, but not in residential. This happens nowhere else in the tax act anymore. Very bizarre. The government asked me in, the Treasury Department asked me into my thoughts on this matter, which was, to be honest, it was a pretty proud day. It comes with, for me, it's like birth of a child, wedding day, Bulldogs winning a grand final, me being invited to the Treasury Department, to discuss and to give my thoughts about this. It doesn't happen very often that this happened. Anyway, so I knew who was on the panel. And I wrote a thesis for them. This is what you should do. It's quite simple in my view. And I gave everyone there a book. And I said, dear Marianne, I'm right. And I gave them each of the book, but they didn't listen to me. They were doing what's called industry consultation. Anyway, so they didn't change it. So the bad news of residential property owners now If it's 1 day old when you buy a property, if it's 1 day old, you can no longer claim the ovens, dishwashers, lights, aircon, all the stuff that's inside that depreciates quickly. And if it's common property, you can no longer claim the lifts, the hose reels, all this stuff that used to be able to depreciate. If it's 1 day old, they didn't change it for brand new. So there was some good news. They didn't change it for brand new. They're never going to want to stifle or to limit people building. And a lot of developers use our numbers to get properties off the ground, to sell to off the plan properties so they can get funding, right? So they'll never stop it for brand new property. Oops. They didn't change the building allowance. So you can still, when you buy a property that's built after 1987, you can still claim the structure of the building. It's just slower. It's still relevant, but it's just a lot slower. Here's the weird thing. They didn't change it for commercial, industrial, or non-residential. So you can still buy a 50-year-old office and still claim 50-year-old carpet. You can still claim 50-year-old aircon. And the reason I think they did that was because the government lobbies for the commercial property groups are far more powerful than the residential lobbies. I can't think of any other reason, to be honest. They didn't claim it. They didn't change it for renovation. So if you've got a Paddington Terrace built in 1900 and you renovate that property, you can still claim the new kitchen that you put in. You can still claim the new oven that you put in. You can still claim that. So you can still, it starts again, it resets. Even though the structure of the building might be built in 1900, when you put something in yourself as a taxpayer, you can still claim those renovations. So here's some hacks you can do right now. Okay, so commercial, beach residential, hands down pat. If you're comparing a 5-year-old commercial property versus a 5-year-old residential, you are going to mathematically win in commercial or non-residential property now. Brand new beats old property. I'm not saying go and buy a brand new one, but it is a massive difference in terms of the depreciation or the cash flow that you'll get on a brand new property. And one tip here that I've been speaking to people about recently is I do a lot of expos where people are buying a brand new property. They come to me and go, oh, look, I'm going to live in it for 6 months and I'm going to claim the $10,000 grant. Okay. The fact that you lived in it for 6 months means you're going to miss out on $60,000 in depreciation. Because you've lived in it, it becomes what's called previously used. So yes, you might get the $10,000 grant, but you've just missed out on $60,000 in depreciation. And they're like, what? No one told me that. No one told you that because not many people know. So I'm not, some people want the grant, but I'm just saying, just know that that's what happens when you live in a property. If you buy it off the plan and want that grant, if you live in it for 6 months, you miss out on those $60,000 depreciation, but you will get the $10,000 grant. So you've got to weigh that up. So to put it in perspective, here's the difference. So if you buy a brand new property for $850,000, pre-2017, you'll get $20,000 in year one. After, you still get $20,000. Because it's brand new, there's no difference, right? But this is perspective now. So say you were to buy a property built in 2000 for $850K. Before these changes, you get $15,000 in year one. Now you're going to get $6,000, a third. And that is really all comes down to the fact that you can't claim the depreciation on the ovens, dishwashers, carpet, blinds, etc. So it's a big jump. And this is when investors need it most, right? At the beginning, before rents have gone up. So you're getting a third in the deductions. And if you buy something before 1987, so build it before 1987, you get zero now. We used to be able to revalue all this plant equipment and get $6,000 in the first year. Now you get zero. So it is a big difference. Here's a tip. If you were to buy a microwave oven for your property, buy one for $295 rather than $305. You get it as an immediate deduction. Simple tip. I don't think your tenant knows the difference between a $295 microwave and a $305 microwave. So buy the $295 one. Another big tip, and this frustrates me, so it's scrapping. And I think there's so many unclaimed deductions that go thrown out. Now, if you're about to do a renovation on a property, you might want to get a quantity survey out to estimate what you're about to throw away. Because the government says that kitchens, shower screens, bathrooms all last for 40 years. Now, we do it all the time. We see people renovating properties that are 20 years old, right? Putting a new kitchen, updating it. Because the government says it's going to last 40 years, if you remove that, you can claim that the original kitchen, if it's been claimed for 20 years, there's 20 years left to go that you can claim as an immediate deduction. All you need to do is get us out before you do that, put a value on it, and you can claim that as an outright deduction. right? So in the bathrooms, it's not unusual for a client of ours to want to renovate a property after 20 years. The government's put, in my view, too many things into the basket that say it's going to last for 40 years. They say every shower screen is going to last for 40 years. I don't want to have a shower in a shower screen that's 39 years old. Just saying, just throwing that out there. Not my type of shower. Fit out. If you own an office, you can claim there's massive deductions available for people doing a fit out. Anything under $20,000, you can claim it as an immediate deduction. We do reports at the moment where a client might spend $200,000 on a fit out and they might get $150,000 as an immediate deduction, because the $20,000 deduction could be $10,000 for the carpet, $18,000 for the aircon, $12,000 for the lights, and it all adds up to immediately be deductible. So if you do own an office, now's a good time to do it. Here's a hack. This one frustrates some people, but I can't see, no one's ever argued with me lately of why you wouldn't do this. Okay, as I said before, you can't claim depreciation on second-hand property unless you buy it in a company name. Companies have bypassed this law. Now, you'd say, well, and all in the past, accountants would say to me, oh, but you don't get the capital gains tax free, right? But is it that important anymore? Because the company tax rate is at 25%. If I'm on 47% and I halve it, what's that, 24%, 23.5%? It's not that much different. So the other advantage with the company, it's more secure, right? Rather than your personal name. And you don't have to distribute funds in a company as opposed to a trust. So you can, if it becomes positive, you can reinvest those funds. And the other thing is, if you could have your wife as a shareholder or partner as a shareholder, and you could then income split. So I'm still waiting for someone to tell me why it's not such a dumb idea now to buy in a company name. It used to make no sense to do it, but because the company tax rate comes down so much, the argument of having a CGT-free entity like yourself that would benefit from that has really waned, especially when you can say, well, you know, I'm going to get $40,000 in depreciation as well that I can throw into that mix. I'm waiting for someone to say why that's wrong, but I haven't had that yet. Okay, if you own an overseas property, we do reports all around the world. So because that income comes back to you here, and so we've done something like reports in 57 countries now. And we have to work out what it costs to build over there, which is always interesting. And because it's, you know, I'm not exactly 100% certain on the square meter rate in Kazakhstan, I've got to be honest with you, but we have to, but the ATO accepts my estimate on that. I just made that up. Skip that. So inspections now. So Wash and Brown, what we do is we look at your property individually and we advise whether a report needs inspection. We've been involved in so many projects around Australia that we have a lot of the costs already. So if we advise you that you don't need an inspection, we'll pass that saving on to you. And if you're sitting here going, shit, I haven't got a depreciation report, we can backdate the report to when you actually bought the property. You can amend your tax returns for 2 years, so don't be worried, we can go back in time. And finally, if you do need a report, our fee is tax deductible, 100% in the year that it's claimable. And we also offer a guarantee. If we can't claim you twice our fee in the first year, it's free. Okay, so now this is all new stuff. Some of you might have seen that before. So I've got to be honest with you. Terry has a company called Hotspotting. He finds the spots. I don't have a lot of input in the spots. I help in finding how I make the yield go up. So you can see from this spreadsheet that Terry gives me every quarter, I find the depreciation based upon our database, and I work out how I increase the yield from an 8. If you look at the top one in the Cairns, it goes from 8.1% to 8.53, and even better, if you're on the higher tax rate, it goes to 8.62. So in this, if you look at the Cairns Edge Hill one, Terry said the yield there was 8.1%. I said, well, there's a $4,000 depreciation deduction. If you're on 37% tax rate, that's a net benefit to you of $1,400. The yield's gone to 8.53. I've said, okay, that if you're on 45% tax rate, your benefit is $1,800. Unfortunately, like everything in life, the more you earn, the more you get. And so the higher the tax rate, the more the depreciation benefit is to you. So at the 45%, you're getting $1,800 because if you get a $10,000 depreciation claim, and you're at 47% tax rate, you get $4,700 net benefit to you. Simple, right? If you're on this, if it's super fund and your income tax in your super fund is 15%, it's only a $1,500 deduction or benefit to you. So the higher the tax rate, in summary, the higher the tax rate, the more the depreciation benefit has to you. So that's what I do. So I work out. So I've taken the cans probably from an 8.1%, gone up to 8.62% net benefit. Let me run through this with you. So I went, okay, so in some of Terry's, in the areas that he's chosen, I went, can we really find these yields? Can we look at it? So I went online, realestate.com, and I found this one here. Warree was one place that Terry recommended. And this is a property for sale for $255,000. Just sold, just recently, 15th of April, sorry. So I went in RP data. Okay, same property, wonderful. Sold for $255,000. I've highlighted the year it was built, 1993. Now that's an important factor because remember I said before, they probably have to build after 1987 in order for you to claim the building allowance. I then went and looked at the rent. So the rental estimate, high confidence from RP data, said I get $404 a week rent, right? Back to the purchase price was $255,000. So $404 times 52 gives me a $21,000 rent over $255,000. 8.23% yield. Pretty bloody good, right? And that was actually a little bit more than what Terry had said in the Warree property. So 8.23% yield. Now that is a gross yield, right? That doesn't take into account your expenses. That's a gross yield. But I plugged in some numbers here for myself. So I went, okay, this is my little spreadsheet of how this actually works in terms of depreciation and the rents and expenses, etc. Because that was a gross yield, right? So the rent received was $404 a week, and I've put it into two columns, without depreciation and with depreciation. So I said, okay, so $404 a week, you both get, obviously with depreciation, doesn't really matter, you're getting $21,000 per annum in. Now, I said your interest costs, I'm going to borrow 80% at 6% of the purchase price, so it cost me $12,000 in interest. Now, this is the one that's is a bit those two are pretty obvious, right? But the hard one to estimate is the other expenses. Now I asked ChatGPT, I normally use about 2%, but I asked ChatGPT and it said from 1.5% to 3% of the purchase price would be the expenses, property management, tax, insurance, etc. Right? I went higher. I went 3.5%. The reason I did the higher was because a couple of reasons. One, the lower the purchase price, the higher the ratio of your expenses will be, because a couple of reasons. Your accounting fees are not going to be much different whether you have a $255,000 property or a $1 million property, right? Your property manager is going to want more. If they're only getting $400 a week rent and you're at 6%, they want more than $24 per week. They'll want 12% to manage it, right? So your ratio, because it's so low, the purchase price, your ratio of expenses is going to be higher than the norm. The other reason I went higher on Cairns is because I've owned a couple of properties up there. I can tell you the insurance is higher than the norm. So I went 3.5%, which gives me expenses of $8,925. So I'm getting $21,000 a week in rent. I've got interest costs of $12,200. I've got other expenses, land tax, insurance, etc., of 8,900. So if you take the 21 from the 12 to the 8, it's costing me physically, my cash outlay, how much I've got to pull out of my pocket to put in is $157. Pretty simple, right? $157. I've got to pull out of my wallet to put in. Now, because I'm not claiming depreciation, that's zero. Now, with depreciation, same thing, but I get a $2,000 loss on depreciation. That's what's called a non-cash deduction. I said before that property was built in 1993. I estimate that cost of construction was about 80 grand, and I have to claim that over a 40-year period. So I've got $2,000 in depreciation. So the depreciation one, I can add my 157 with my $2,000 depreciation. I've got a negative loss of negative 2,157. I submit that to the tax office, right? If I'm on a 37% income tax band, I get a tax refund of $798. I offset that with the $157 I have to physically outlay. It's paid me to own. depreciation has turned a negatively geared property into a positively geared property. And that's the power of depreciation, right? It's already in the property when you buy it. You just need Washington Brown to work out what that number is. That's the difference. So it is in the without depreciation one, it's cost me money. If I didn't claim that 2,000, right, it's paid me now. That's what depreciation is. So I went again, I did another one. I found another place, More Well. Again, wanted to test Terry, can I actually find these places? And as I said before, some of the areas was harder to find because there wasn't much stock on the market, and I think buyers agencies see this report and bloody go and buy them. Anyway, but this is another property here. This is in More Well. Okay, so it was built in 1960. So according to what I said before, well, there'll be no claim. However, this is what we do. So we go through, this is the property price value, 325. The rental estimate was 414, pretty good yield, just looking at that. Normally, whenever I've been growing up or when I was younger, I'd always want to buy something where you drop off the last 3 zeros, right? It was 325, I'll drop off the last 3 zeros. That should be the minimum rent I want, right? That was always my it's harder in Sydney, but it used to be, believe it or not, you used to be able to do that in Sydney. You buy something for $1 million, you used to be able to get $1,000 rent back in the day. Not so much now, but it used to be like that. So here, okay, 325, I've got 414 as a rental estimate. Okay, so I said before this was built in 1960, but renovations. Look at this. This is not 1960s. That kitchen's not 1960s. That tile's not 1960s, etc. That bathroom's not 1960s. So this was the facade of the building before. So I've gone through and looked at all the existing photos I could find on RP data or Logic. And look, rendered, new wall, right? And then what we also then do is we use aerial mapping. We go through the property and we go, okay, what does anything change? Now, this particular property hasn't, but sometimes it's amazing what we'll find. Carports, extensions, etc. This was back in 19, and this is only going to get better with time. So we go through aerial mapping and go, okay, well, this particular one. So you can see up the top here, the whole timeline of photos that we can look at and you search. So here, there's no pool. Oh, there's a pool now, right? To the 90. Sadly, in this case, the pool is gone. But you see what I'm saying, right? So we can go back in time and say, well, this has changed. There's been a new carport here. And often it's really hard to find that stuff, but it's getting better and better. And we've got other ways of looking at it. I'm showing you that this is the process that we go through to work out how we can maximize your claim by looking at past photos, past aerial mapping, and defining what we can get in order to get you the most depreciation you can. Because, you know, if I just went out to that property now, I wouldn't particularly know that that wall there is new, right? But now I do, right? I wouldn't know in this particular case that there was a pool there. How would you know that when that was installed? But with aerial mapping, you can, and that's what we do all the time now. So this particular case, this is my final slide, I think. This particular case is a $404 a week rent. It's 21 grand. You're borrowing at 6%, same thing, of 320. This is a 325 purchase price. So 15 grand in interest payments. I only used 2.5% expenses this time because it's, you know, it wasn't in a flood zone. 8,100. So my cash outlay here was 2,197. Again, I reckon all those renovations would have cost about 80 grand. So with the depreciation one, there's a $2,000 depreciation deduction. So you've got if you don't claim depreciation, you've only got a tax loss of 2,100. If you do, you've got a tax loss of 4,100. So you get a bigger tax refund. That's it. That is depreciation in a nutshell. The non-cash deduction that's in the property when you buy it helps you afford the property. Simple as that. And so in this case, whilst it's still negatively geared, it's not costing you as much to own. Simple as that, because you've claimed the depreciation of the property. Now, thank you for coming. If you're sitting there, I'm going to offer you that book for free. All you have to do is pay for postage handling. You can scan that QR code, and it'll take you to a landing page where you can pay the brand sum of $99.95, and I'll send you a signed copy of my book. Simple as that. So yeah, I think that's it. I think, Terry, we will put a in the link here, we'll put a. I'll leave it up there just for 1 second. But we'll put a in the chat bot. Sorry, the chat. It's not chat bot. So it's all about bots these days, isn't it? In the chat, we're going to put a link for if you do need a report, that you'll be able to get a discount report, because as a thank you for coming to this webinar. If you could put that in there, Terry, or your friend.
Yep.
Yep.
Well, just leave that that slide up there so people got plenty of time to scan that barcode if they want to get a copy of the book.
I thought that was pretty cool. That was pretty cool. The going deep diving into some of your areas. I thought it was
wonderful stuff. We've got a lot of questions. I'll try to get through as many as we can in the next 10 minutes or so. Some for me, perhaps some for you. Leroy's asking, can you apply the sort of strategy for locating growth suburbs and locations for commercial properties and different types of commercial property? I'd say the answer to that is definitely yes. We find Tyron and I, with another colleague, did a series of live seminars in 3 cities earlier this year. And one of the themes for me was that the criteria we use to identify good places to buy houses and units applies equally to good places to buy non-residential property. So if you're buying a small retail, sort of workshop property, small industrial, etc., the same criteria apply. So you can use those locations to look for small commercial. And I think, Tyron, you would say that your deductions actually would be better and more powerful with commercial forms of real estate than residential, generally speaking.
Not generally, 100%, because you still claim all the plant equipment components. So definitely more powerful.
Yep. Anita's asking, can I buy an investment property in a mining area? Well, you certainly can, Anita, but the question is deep. Why would you? Very high risk real estate. The only examples, I've been doing this for 40 plus years, researching and writing about real estate. The only examples I can find of massive decline in property values has been in mining towns where they go through a spectacular boom, and then because it's a very volatile industry, values have collapsed and ended up less than half what people have paid.
Can I kick in here just as an example here? So we do reports all around the country, obviously, but we did reports in Moranbah, right? And Moranbah, I think, was probably the biggest up and down I've ever seen of any area. And we did a report where a client bought a property for like 900K, and then we said the building allowance was $500,000. Same property we did sold for like 3 years later for 120K, right? And the only good thing was, because the building allowance is based upon the construction cost, they still got a $500,000 deduction. So regardless of what you paid, but I still don't think it was a good investment. But it's just shown the gap from 900 to 120. I've never seen anything like it. That was in my town.
The median house price peaked at 750,000 in Moranbah in central Queensland, dropped as low as 150,000. So if you bought at the peak of that market, you would have been a devastated investor. So not to be recommended for the faint-hearted. Jeet's asking, with prices surged all over Australia, where does affordability rank as a driver for high capital growth? I think it ranks very highly, Jeet. I think all the evidence, all the research evidence shows that the places that have led on capital growth in the last 12 months, in the last 5 years, and going back further, are the places that offer affordability, far more so than the swanky, prestigious, ritzy areas. So you're getting better percentage capital growth as a generalisation in those cheaper areas by far, because the weight of demand goes to those areas. Affordability rules these days in real estate. It's becoming harder and harder to find, and that's where the weight of demand goes. Anita, another question from Anita. What about Dubbo and Wagga Wagga? I did talk about Wagga Wagga earlier as a place that I would certainly consider. If when Tyron asked me 3 places that you would consider buying for, say, 500,000. Dubbo, similar sort of a place to Wagga Wagga. I prefer Wagga Wagga because it's on the route of the Inland Rail link, and it's got perhaps a broader economy, but both are good. question, Tony, can you apply these drivers with identifying commercial, positive, high yield property? I think it's a similar question to the one earlier. And as you've pointed out, you certainly get better depreciation claims. You would agree with me, I think, Tyron, that you don't buy for the tax benefits. That can be, though, a really positive bonus to buying good real estate.
It's the icing on the cake. I always say, you don't buy under depreciation. Just make sure the investment stacks up first, and then worry about the depreciation. Right? I've had some clients ring me up and say, "Hey, Tyron, this one's got a bit of depreciation. Should I buy that?" I'm like, no, you got it all wrong. Now, there's many other factors you should consider before you get the depreciation. But don't get me wrong, once you buy the property, make sure you get the maximum depreciation.
Yeah. There's a number of comments regarding your suggestion about buying in a company, suggesting there are also some disadvantages of that approach, and I'm sure that's correct. There's always pros and cons, no matter.
Absolutely.
What
Speak to your financial advisor.
Yeah, it's always very wise to talk to a financial advisor and accountant, particularly about entities that you're buying in, because there are always pros and cons. There's always a flip side, whether you're buying in your own name, in joint names, a self-managed super fund, a trusted company. There's advantages and disadvantages. It very much depends on your personal circumstances as to which might be best for you.
And it's best to do that before you exchange, because it's an expensive process to change it from one entity to the other. You got to pay stamp duty again, etc. So you do it before you exchange.
Absolutely. I think too many investors try and neglect those important early steps before getting excited about buying real estate and finding something to buy and finding out too late that they've bought in the wrong entity or they haven't considered. You've got to talk to a range of advisors, including Washington Brown for depreciation. Do all your sums before you commit to a contract.
Yep.
Okay. Rebecca is asking, if you're picking one location in New South Wales to invest now, what would you choose? You got any thoughts on that, Tyron?
Clovelly, where I live, is beautiful. I'm not joking. Oh, look, I've got to. I know it's a bit sad, but I've got to. I've become a bit like Chris Gray, just blue chip. I know it's easier said than done, but I've kind of reached a point where I've just slow and like I'm just a bit Randwicky and eastern suburbs of Sydney. Sadly, but that's for me.
Well, my answer would be, well, I've talked about Wagga. It's a place that's very high on our list at the moment in New South Wales, but Wollongong is a very good place to consider. Very strong regional city, diverse economy, ticks all those boxes we talked about at the beginning. Big uplift in buy demand there recently, and it also extends into neighbouring Shoalhaven local government, which includes towns like Nowra. So that's a good place to consider.
I guess it depends what your goal is, isn't it? Really, like I guess as you get older, you also want security. And for me, it's like I'd want to be able to sell something if I wanted to. And I know if I buy a unit in Bondi, I'm always going to be able to sell it tomorrow. So you might not have the fantastic growth you want, but I'm always going to be able to sell it, Terry. And I've been through a few bumps in my life where that's part of my investment strategy, is being able to liquidate when I want
to. Okay. Keep working through some of these questions. Jeet's asking depreciation question. I bought an old house which had a new roof. So would that be 2.5% of the backdated value of the new roof? How many years can I claim it for?
Very good question. Yes, and the answer is yes and yes. So it'll be 2.5% of the value of the roof, and how long you claim it for depends on when the roof was finished. So if the roof was completed 5 years ago, you'd have 35 years left. If the roof was completed 10 years ago, you'd have 30 years left, because it's a 40-year claim, because it's a capital improvement item and it lasts for 40 years. So that's how that works. Whereas if you owned a property and you had to repair the roof, you claim that as an outright deduction. But if it's a whole new roof, it might not be considered a repair. It's a very fine line. It's a very grey area sometimes, what's a repair and what's not. And it's one of the things that the ATO every year tries to crack down on, because people think that they think they're doing a repair when they're really doing a capital improvement. And here's another tip: if you were to buy a property and you immediately fix the plumbing, you fix this, you immediately fix the tap. The government says that that's what's called an initial repair, even though it would be not you would think would be a repair. The government thinks that's an initial repair, and they claim that as they say that that's a capital improvement, which you have to claim over 40 years. So basically, the wear and tear of the item that you're about to repair had to have occurred when you owned it, right? So if you immediately buy a place and what you consider as a repair everything, that's what the ATO doesn't think that. The wear and tear didn't occur when you owned it. That's the difference. And they crack down that every year. They crack down that every year.
All right, still lots of questions. Question about Muswellbrook versus Tamworth versus Gunnedah. Which one is better? Look, there's no one right answer to questions like that. It depends on you and what you already own and your criteria. But of those locations, I'd go for Tamworth because it's a larger, more diverse economy with infrastructure spend happening. Although Muswellbrook has got some big things happening in the background as well.
That was one of your tips in there. That was one of your tips in our series, wasn't it, Tamworth? That was one of your big tips.
Yep, absolutely. We have a high ranking for Tamworth in New South Wales. Gippsland Latrobe area, well, that includes Morwell, which is one of Tyron's case study examples. Really good level of affordability there, pretty good growth prospects in towns like Morwell, Moe, Traralgon, but the rental yields, which is true generally speaking for regional Victoria, aren't as strong as other parts of Australia. Keep that in mind. What do we think of Geelong? Always a good, strong option. Geelong, it's more expensive than some of the other regional cities of Victoria, but will always be a place I think that will show good capital growth because the economy is just so strong and good connections to Melbourne. Another question about Traralgon. Yes, it's a good place to consider. Median house price is now around 500,000. Rental yields a little bit weak, but that's true, generally speaking, of regional Victoria, unfortunately. Victoria Metro, question from Pabath, which I assume you're meaning Melbourne. That market is showing signs of recovery after a couple of weak years, and specific parts of Greater Melbourne in particular are rising strongly, including the Frankston area. And one of the reasons for that is they're building $1 billion hospital there, which is one of the factors we talked about right at the beginning that can be a big driver of capital growth.
Share my screen. Wait, why am I sharing my screen?
Well, you're giving people plenty of chance there, Tyron, to barcode to get a copy of the book.
Oh, good.
We'll just do one last question because we've actually gone past the hour. John's asking, if I buy a furnished property, agree to a price for the second-hand furniture, can you deduct the furniture as a one-off capital spend?
No. So again, it's got to be brand new. So even if you buy what you think might be brand new, you might on eBay, you buy it yourself brand new. The furniture has to be bought from Harvey Norman or brand name. It has to be brand new. You have to have a receipt with GST payable in order to claim any of the furniture anymore.
Okay. All right. There were a few more questions, but we never seem to get through all of them.
That was fun. Yeah.
Okay. So have we told people how to get in touch if you want more information? It's there in the chat box. The link. Click on that if you'd like to follow up. Then make contact with the team at Washington Brown to find out more about getting a depreciation schedule done for a property that you own or are thinking of buying. Beyond that, thank you, Tyron, for your participation today. I think great information. I think it's exciting for investors to know that you can buy in affordable areas, get great capital growth, and get a really high rental yield if you choose your location well, and improve that rental yield through intelligent use of depreciation. You get that trifecta, the win-win-win that we talked about.
Boom, boom, boom. Excellent. All right. Thank you, Terry. Thank you for the standing report you've done. That 80%, it's bananas good.
Yeah, okay, so it's the Pulse report, which is produced quarterly by Hotspotting and Washington Brown in association with each other, and we have 50 locations with above average rental yields and good prospects for capital growth, not to be missed. Let's do it again soon, Tyron.
Sounds good, mate. Thank you.
Okay.
Thanks for the opportunity. Thanks everyone for coming.
Okay, thanks everyone. Bye for now.